As we know, currency futures and forwards are also very popular. And we learn here how to price a currency forward or future. And the underlying concept here is the interest rate parity. Uh, Interest rate parity uh, implies that the forward rate or the future rate on a currency should reflect the interest rate differential between two countries. And this is important to avoid arbitrage. Let's have a look at an example here. Suppose the interest rate in UK is 10% and the interest rate in the US is 15%. The spot rate for $1 is £1, so that is £1 per dollar, and the forward rate is also £1 per dollar. Now this is not consistent with interest rate parity theory, because the interest rate in the US is higher than the interest rate in the UK. So ideally the forward rate should show a depreciation of the US currency. Now, an investor can take advantage of the forward rate mispricing here and given the available set of interest rates. So let's suppose there is a UK investor who has £100. So it is attractive to invest in the US to earn 15% given the present exchange rate and the forward exchange rate. The investor can devise a strategy where he or she is able to earn a higher rate, that is the US interest rate, compared to what is available locally in the UK. So today the investor converts £100 into $100 at the spot exchange rate, which is $1 equal to £1. Then the $100 from conversion is deposited in a US bank at 15% for 1 year. And then, as the investor knows that he will receive $100 plus $15 as interest 1 year from now from the US bank deposit, so sells a forward contract with a notional value of $115 with an exchange rate of £1 per dollar 1 year from now. So these transactions take place today. 1 year later, the UK investor will receive $115 from the US bank and then settle the forward contract by delivering $115 and receiving £115. The $115 delivered in the forward contract comes from the US bank deposits, which matured to $115, and hence he is left with £115 after 1 year. £115 after 1 year is implying a 15% rate of return, which is the US interest rate. So a UK investor in this case is able to earn a higher interest rate of 15% available in the US, taking advantage of the exchange rate mispricing and the differential in interest rates here. Had the UK investor invested in UK bank deposits, 1 year later he would have had only £110. As per the interest rate parity theory, this forward price is too high. The dollar is too expensive in the forward market. It is not consistent with the interest rate differential. The interest rate parity theory implies that the country with the higher interest rate should see its exchange rate depreciate, that is, the currency should depreciate, and the country with the low interest rate should experience its currency appreciate. This is necessary so that such transactions are not possible. For example, the correct forward price in this case should have been 0.9565, which is obtained using this formula. We are going to have a look at it in detail later. Now, if we use this as the forward rate, you can see that 1 year later, $115, if converted back into pounds, they will not be $115 but 110. So just let me show you that here. So if the forward rate is 0.9565 and you convert $115 1 year later, they will be approximately equal to 110. In that case, the payoff here will be exactly equal to uh, the one if somebody is investing in the UK. So if the forward rate is as per the interest rate parity theory, then there is no incentive for the investor to convert pound into dollar and then invest in the US and then convert back using the forward rate agreement and earn a higher rate of return. Let's have a look at another example from an arbitrage's perspective. So an arbitrager would not invest his own equity, would take zero risk and would earn a positive return. So how come an arbitrager earn arbitrage profit in the given scenario? So as we know, the spot price is £1 per dollar and the UK interest rates are 10%, the US interest rates are 15%, and the forward rate, as we saw, is overvalued for the US dollar, and that is £1 per dollar. This forward rate should have been correctly priced at 0.9565, consistent with the interest rate parity theory, but it is not the case. So the arbitrager will take advantage of this. So today the arbitrager will borrow £100 from a UK bank at 10%, convert the £100 into 100 US dollars at the spot rate of £1 equal to $1, and then deposit the $100 into a US bank to earn 15% for 1 year. At the same time, the arbitrager enters into a forward contract to sell $115 1 year from now at $1 per pound, and he knows what exactly he will receive 1 year later from the US bank because it is 100 plus 15%. Now 1 year later, the US bank deposit will mature to $115. The arbitrager will receive this amount and then settle the forward contract where he will deliver $115 received from the US bank and from the counterparty receive £115. So now effectively the arbitrager has £115. Using this £115, the arbitrager will settle his UK bank loan, which is £100, but there is a £10 interest on it also. So the total payment made to the UK bank will be £110. The net cash flow to the arbitrager is £115 minus £110, that is £5. Now this is arbitrage profit, which is implying that the arbitrager has taken zero risk, has made zero equity investment out of pocket, and has earned positive returns. The spot rate on a forward contract here is denoted as S0, which is the spot rate in domestic currency per foreign currency. The foreign interest rate is rho, and the domestic interest rate is R. In our cases, the foreign rate was the US rate 15% and the domestic rate was the UK rate, that is 14%. The holding period was T, that is 1 year. So assuming a notional value of $1, you take 0.8696 in pounds and convert that into 0.8696 dollars, and then you keep that amount into a foreign currency deposit, that is US bank deposit at the US interest rate 15%. 1 year later, the 0.8696 dollar deposit in the US bank will grow to $1 at 15%. Now, you also enter into a forward contract to sell the same foreign currency unit, that is $1 that you will receive 1 year later at the forward rate 1 year from now. So when the contract matures 1 year later, you will deliver the $1 foreign currency deposit and receive domestic currency units. We illustrated this in our previous two examples. So an investment of this many units of domestic currency grow to this many units of domestic currency without any risk in 1 year or time t. Therefore, such an investment should earn the domestic risk-free rate. Symbolically, the formula for the forward price in such a case can be written like this, which is equal to the current spot price multiplied into 1 plus the foreign interest rate raised to the power minus t into 1 plus the domestic interest rate raised to the power t. This is known as the interest rate parity, where the forward price is reflecting the interest rate differential between the two countries, and sometimes it is written as this. We can see that when we take this down to divide, the minus sign here becomes positive. So both these expressions can be used. So here we have an example from a European perspective. So the exchange rate is quoted as 1.0304 euros per dollar. That is the spot rate. The US interest rate is 5.84%, the euro rate is 3.59%, and the time to expiration is 90 days. So 90 divided by 365, that is 0.2466. The forward price using the interest rate parity expression that we have just seen is the spot price into 1 plus the foreign interest rate raised to the power minus t multiplied into 1 plus the domestic interest rate raised to the power t, and if we solve this we get the forward price of $1, that is 1.025 euros. As we see here, the US rate is higher than the euro rate, so therefore the euro must appreciate, and in other words the dollar must depreciate, so that there is no arbitrage present. Now suppose that the actual forward rate is 1.03 euro instead of the one implied by the formula. In that case, you will buy $0.986 today for 1.0161 euros, and then you will sell one forward contract at the forward price of 1.03 euros. So you see, you are buying this many units of the foreign currency, and for that you need this many units of local currency, and once you have purchased the foreign currency units, that is borrowing this much in your local currency at 3.59% and then using the proceeds here from this to buy $0.9861, you keep that deposit in a US bank to earn 5.84%. At the same time, you enter into a forward contract to sell $1 at 1.03 euros 90 days from now. So you earn 5.84% on the deposit of 0.9861 US dollars. This will grow to $1 in 90 days. Now, after 3 months, when the contract expires, you will deliver this $1 that you get from the US dollar deposit, and you will receive 1.03 euro in domestic currency units. Now, the return for you from this transaction is that you invested 1.0161 euros and you are getting 1.03 euros 90 days later. So your effective rate of return is 5.66%, which is greater than what you are earning in your local currency, that is 3.59%. Such a transaction is called a covered interest arbitrage because you have covered the forward position, that is when you need to convert 90 days later into euro by the forward contract. There can be uncovered interest arbitrage, which we are not covering here, in which you will not involve any forward buying of currency or forward selling of currency. Now, the formula for the forward price of a currency can also be written like this. Now, here the important factor to note is that the spot price here is quoted as the foreign currency units per unit of domestic currency. So in that case, you will have to use this formula. Specifically, when the currency rate is quoted as dollar per pound, then you are going to use this formula where you have the forward price of the currency equal to the spot price today as expressed like this into 1 plus the foreign currency interest rate raised to the power t into 1 plus the domestic currency rate raised to the power minus t. If the currency rate is quoted as domestic currency per foreign currency, in that case the formula would be the spot price multiplied into 1 plus the foreign currency rate raised to the power minus t into 1 plus the domestic currency rate raised to the power t. It is a common misconception that forward discount or premium is interpreted as to imply the strength or weakness of a currency. It is not correct. The principle of arbitrage is what is responsible for any forward premium or discount. Any forward premium or discount is due to the interest rate differential between the two currencies. Now we look at the spot prices and try to understand the relationship between spot prices at expirations and the current spot prices. We try to understand the factors that explain the spot prices at expiration and the spot prices today. So the first expression here if we look at it, it says that the current spot price is equal to the spot price at expiration minus the storage cost minus the interest foregone on the spot price. Here our assumption is that we know the spot price at expiration with certainty. Now, if we relax this assumption and we allow uncertainty but still hold that investors are risk neutral, we can rewrite this relationship in terms of expected spot price. Now here we are allowing that the spot price at expiration may be different and can be any number. However, we have an expected spot price which is the average of all that is possible at expiration. Now, we can further refine this by allowing now that the investors are not risk neutral but risk averse, and if they are risk averse, they will require a risk premium for taking this risk of unexpected spot prices at expiration. So therefore, if we relax this risk neutrality assumption and start assuming that the investors are risk averse, in that case the relationship has one further element in terms of the expected risk premium, here denoted by this symbol. So we are saying that the spot price today and the expected spot price at expiration are different for three reasons. Basically, the storage cost, the interest foregone on the spot price, and the risk premium. So let us now define the interest foregone on the spot price as the net interest, because we saw that some assets have interim cash flows, like stocks have dividend and bonds have interest. So this is now representing net interest or net cash flow on the underlying. So this is equal to the interest foregone minus any cash received. That cash may be dividend, that cash may be interest. So now we can define the cost of carry as the storage cost plus the net interest as defined here. So we can denote the cost of carry here as theta. Now you can see how the cost of carry is only meaningful for storable assets. For non-storable assets, an item such as electricity, the cost of carry is meaningless. Stocks, metals, and some natural resources such as oil are indefinitely storable. For many agricultural commodities, there is limited storability. However, grains have fairly long storage life. Similarly, in financial markets, treasury bills have a maturity of up to 1 year, so their storability is limited. On the other hand, treasury bonds have long-term maturities and hence have long storage life. It is important to understand the relationship between spot prices today and the expected spot prices in future, and to know about the factors that are responsible for the differences between the two. We will use the relationship between current spot prices and expected spot prices in future to understand the pricing of futures and forwards. Let's buy an asset in the spot market paying S0 and sell a future contract at the future price. Now for the asset we have purchased in the spot market, we will incur cost as we store it. At expiration, we will settle the future contract by delivering the underlying asset that we have been storing over the period, and we will receive the future price. So our profit from the position would be what we have received from the settlement of the future contract, that is the future price, and the cost of buying the asset plus the cost of carrying the asset, that is the carrying cost here. Now if we set the profit equal to 0 here, we can see that the future price is equal to the spot price plus the cost of carrying. This is important because otherwise there will be opportunity for arbitrages. These are explained in detail in figure 8.2, the payoffs from buying the underlying and the payoff from selling the future, and how this accumulates to the total value from the position at the end of the contract period. This clearly shows what will happen if the future price is more than the sum of the spot price plus the cost of carry, or if the future price is less than the sum of the spot price plus the cost of carry. There will be opportunities for arbitrage in both cases. Figure 8.3 illustrates the determination of future prices and how they relate to spot prices, and how even a spot price is determined. So let's have a look at this. Now here we see that the prices in the spot markets are determined by storage market, the probability distribution of spot prices at expiration, the bond market, and the investors' risk preferences, and then the future market is related to the spot market, as we discussed in the previous slide, that the relationship between spot prices will help us understand the pricing of future market. So we see the information in the spot market is helping in determining the prices in the future market. A contango market is where the future price is greater than the current spot price. Table 8.2 provides an example of a market in contango. So we see the spot price on 26 September is 36.75, and then we see that the prices for October, December, March, May, July, October and December deliveries are more than 36.75. So in all these cases we see that the future price is higher than the current spot price. So such a market is considered as a contango market. In Backwardian market, the future price is less than the current spot price. This happens because of convenience yield, denoted as chi. An asset that is in short supply will have high current spot price due to high demand for current consumption. It may be expected that in future demand and supply will return to normal. Therefore, future prices are low. As a result, spot prices are higher than future prices right now. Therefore, the market becomes Backwardian or inverted. Let's have a look at table 8.3 for an example of a market in backwardation. Here we see that the prices of futures are showing a downward trend as we move farther into the future. So the price of the MAC contract is 545.75, while the price of the August contract is 536.5. A market may be Contango and Backwardation at the same time. Here in table 8.4 we see that the market is first Contango. We see the spot price of 159 being less than the future prices for December, January, March, May, July and August contracts. But then as we see that the price trend is downward for the remaining of the months, from September onward the market is in backwardation. Now we see the relationship between future prices and risk premium, and there are two hypotheses that we are covering here. The first one is the no risk premium hypothesis, and the second one is the risk premium hypothesis. The no risk premium hypothesis assumes that there is no risk premium in future prices, and therefore the future price today is equal to the expected spot price at expiration. That is the best estimate of the future expected spot price is the current future price. It assumes that the market consists only of speculators, implying that all players in the market buy and sell contracts to speculate. Of course, this is an unrealistic assumption. The no risk premium hypothesis means that on average, the future prices today are equal to expected future prices at expiration. This is what it implies. Now, we know that expected future price at expiration is equal to expected spot price at expiration, and we can therefore deduce that current future price is equal to expected spot price at expiration. This expression implies that the best estimate of expected spot price is the future price today. Figure 8.4 provides evidence to support this. Though the future prices and spot prices are not equal, they are very close here. Now, the no risk premium hypothesis postulates that as all players are speculators, that is, they are speculating like gambling, there are no consistent winners and losers, and hence no risk premium is involved. For the second hypothesis, that is the risk premium hypothesis, we have the expected future price at expiration greater than the future price today. Now, future markets and spot markets are assumed to be dominated by individuals who hold long positions in the underlying commodities and assets. They need protection for their long positions by selling future contracts. However, they need individuals who are willing to take long positions in future contracts that they want to sell. And to induce these individuals, in other words, traders or dealers, the future price in the future contract today must be less than the expected future price at expiration. So the individuals are hedging by selling futures. So they are transferring their risk to the buyers of these future contracts. So they must offer a risk premium to those who are buying the future contracts. Therefore, we see that the future price
will be less than the expected future price at expiration, and the expected spot price should be equal to the future price today plus the expected risk premium. And we already have stated that the expected future price at expiration should be equal to the expected spot price at expiration. Figure 8.5 shows that future prices are consistently higher than the spot prices, consistent with the risk premium hypothesis for the S&P 500 futures and spots. Now, a market where the future price today is more than the expected spot price at expiration is known as a normal contango market, and a market where the future price today is less than the expected spot price at expiration is considered in normal backwardation.